Hello, friends, and welcome to Advanced Financial Modeling, Stock Research, and Valuation course. We have reached the most significant part of this course where we learn to do discounted cash flow modeling. This is our Chapter 4, Assignment 4. Namaskar, hello, and welcome, friends, to this Advanced Financial Modeling, Stock Research, and Valuation course. This course is for investors and finance students who are looking to understand how professionals value stocks. The course comes with a dual certification program. One is for the course completion and one is for internship completion. So, for those who are interested in enrolling to the course certification program, the details are given in the description and in the end of the video. You can check that out. Meanwhile, the entire course material is available freely on YouTube, like this video, so you can learn it freely anywhere, anytime. Students who are pursuing courses like MBA Finance, CFA, CA, CPA, MCOM, BCom have all taken this course and benefited from it. If you are an investor or if you are a finance student, this course is for you if you are looking to understand how professionals value their stocks. What is the eligibility for this course? The good news is we have structured the program assuming that the viewer is a beginner. So, from a beginning stage, if you do all the assignments and all the chapters one by one without skipping them and applying them hands on, then by the end of this course, you are assured to have an advanced level knowledge of how stock valuation is being done. And regarding the course content, let us discuss that now. First, we come to the stock filtration. Any stock exchange, if you visit, you will find that there are thousands of stocks. For example, Nasdaq has more than 3,000 stocks. NSE and BSE together have around 8,000 stocks. So, to begin with, we need to find out a way where we can filter out all these thousands of stocks and reduce the number to a manageable list which we can do deep analysis on. In the first assignment and first chapter, we show you an efficient way, an intelligent way of segregating the stocks and filtering them out. In the second chapter and second assignment, we try to understand how to interpret the cash flow statement, the balance sheet, and the income statement and bring them together to do ratio analysis. Ratio analysis brings us to chapter 3 and assignment 3. In chapter 4, assignment 4, we are going to study together in a detailed way how to do discounted cash flow valuation. Apart from that, we will also learn how to do dividend discount model valuation and residual income valuation. After learning how to do discounted cash flow valuation, we get into detailed reading of an annual report. We take a company which is listed in the stock markets and we read the annual report together along with you. After learning discounted cash flow modeling and valuation, we move into valuation of financial institutions, that is, banks, NBFCs, etc. The valuation of banks and financial institutions is a bit different than the typical manufacturing company or even an IT company. So we understand how to mathematically value a bank or a financial institution in this assignment. This is assignment 6, chapter 6. Assignment 7, chapter 7 is about understanding the monetary system and the currencies. We delve deep into the history of monetary system, the evolution of currencies, and the impact of central banking policies and the state's financial and monetary policies on the economy, especially during recession times. In the last chapter, that is assignment 8, chapter 8, we move into understanding the specific analytical parameters for specific industries and specific companies. For example, a mining company is analyzed differently than a retail company. A retail company is analyzed differently compared to an IT company. An IT company is analyzed differently compared to a banking company. So specifically, each of these industries have some specific parameters. We understand what those parameters are and how to understand them in this last assignment. And once all these things are over, the main goal is for you to become capable of valuing stocks like professionals do and creating reports like professionals do. So without further ado, let's get started. This is the final segment of Assignment 4, Chapter 4 of Advanced Financial Modeling, Stock Research and Valuation course. Here, we select a real listed company and find its intrinsic value with three methods: discounted cash flow valuation, residual income valuation, and dividend discount modeling. Let's get started.
So friends, hope you have gone through the three class videos related to this assignment. The three videos were valuation through free cash flow to the firm, residual income valuation, and valuation through dividend discount model. Now I have chosen Eicher Motors to apply all these three methods and demonstrate it in a practical level. We are going to do it in a practical level also. Now the reason I have chosen Eicher Motors is because firstly, for free cash flow valuation method to be applied, a company needs to have free cash flows. Now Eicher Motors seems to have free cash flows and sufficient amount of it. The second is, for residual income, there are no conditions as such, but we can compare the return on equity with respect to the cost of capital to find out whether the current book value will be more than the per share value that we project through residual income, or whether it will be less. So what I mean by this is basically, if the cost of capital is less than the return on equity, the valuation that comes per share will be higher than the book value per share. But if the reverse happens, that is, if the cost of capital turns out to be greater than the return on equity, then what will happen is our residual income model will throw out a valuation or an intrinsic value per share which will be less than the current book value. So for that, to understand whether which side of the coin we are in, we would very soon calculate the cost of capital and compare it with the return on equity. The third is, for dividend discount model, a company has to be giving out dividends. So here you can see, if you see the numbers, 17%, 21%, 22%, 20%, later 34%, 35%. So they are giving out dividends and there is a trend to it. So we can apply it and try and do some valuation around dividend discount model. So all these three methods we will be able to apply. So first of all, let us look at free cash flows. So friends, this is the trend that is there for free cash flow to the firm for Eicher Motors. You can see from 2010 to 2015, the numbers were not that great, but from 2016 onwards, we can clearly see a trend. And what we'll do is we'll try to create a projection from this trend and try to have our future valuations based on that, right? The next is the cost of capital. Is it more than the second thing is the cost of capital. So friends, you can see if you search in screener the debt amount. So the debt for Eicher Motors is 419 crore, right? Currently it is 419 crore. And the interest it has paid in 2024 is 51 crores. So on 419 crore of debt, it seems to have paid 51 crores of interest. So we can measure the interest rate from it, or the cost of debt from it. So one part of the cost of capital is measured from here. Second thing, if we want to measure the cost of equity, then we will apply the CAPM method. That is what for that we'll need the beta, we'll need the risk-free rate, and we'll need the market premium. So we have all these numbers. Let us calculate the cost of capital. Cost of capital for Eicher Motors. So friends, we already know the expression for cost of capital, right? So this is basically cost of capital is equal to market value of debt divided by the total proportion of capital in terms of market value, that is market value of debt plus market value of equity. This multiplied by the cost of debt multiplied by 1 minus tax rate, right? This is the first expression, plus market value of equity divided by total market value of the capital, that is market value of debt plus market value of equity multiplied by the cost of equity, right? Now this cost of equity we'll be finding out through CAPM method. We'll see how to measure that. So this is the expression for cost of capital. Now, one thing we'll modify here is the market value of debt. It is very difficult to find out the market value of debt. Okay, so we will use the book value of debt to measure our cost of capital, right? So this is what we'll use. So the debt given in the books is 419 crores, right? So let us find out all these values, friends. So we said we'll be using the given value of debt. This is 419 crore divided by 419 plus market value of equity. Market value of equity is nothing but the market capital. So let's see what is the market capital of Eicher Motors. It is 127,889 crore. 127,889 crore. All these values are in crores, right? Cost of debt. We saw they were paying an interest of 51 crores and the debt amount is 419 crores, right? This is it. And we will use the tax rate here, which is, let us find it out. So the tax rate is 21, 22, 29, 29, 30, 22, 25, 24. Let us keep a standard level here. Let us keep it at 25%, or we can do one thing, we can put it in Excel and take the average. Let us do that. So the average is coming 26%. Average is 26%. So we'll use that. 1 minus 0.26. The first expression, we have all the values put in here. We just need to calculate it. Now for the second one. For the second one, the market value of equity we already have 127,889 divided by 127,889 plus 419 multiplied by CAPM value of cost of equity is given by the risk-free rate. Let me write it separately. It is given by the risk-free rate plus the beta of the stock multiplied by the market premium, which is given by market return minus risk-free rate. Now for risk-free rate, we'll be taking the 10-year government bond. This rate will be taking. For beta, we'll be taking 5-year monthly beta. For market rate, we'll be taking the value of, let's say, last 20-year Sensex returns. Okay, the total returns. Let us find it, friends. So friends, the 10-year government bond is rated at 6.96%. The 5-year monthly beta of Eicher Motors is 0.59%, right? So we plug in the values here. So RF is equal to 0.0696, beta is equal to 0.59. We now need the market return. So in last 20 years, friends, the market return has been, you can find it in Google itself, the total return including the dividends, that is, the return has been 15.1%, that is 0.151. Now we will be easily able to calculate the CAPM rate or CAPM cost of equity. Let us do that. RF plus beta into RM minus RF. This is equal to 0.0696 plus the second expression is 0.59 multiplied by 0.151 minus 0.0696. Let us calculate it, friends. 0.151 minus 0.0696, this is equal to 0.0814 multiplied by 0.59. This is equal to 0.048026 plus 0.0696. This is equal to 11.76%, 0.1176. So we can just plug in the value of cost of equity here, 0.1176, right? So friends, this value now we can easily calculate. 419 divided by 419 plus 127,889. This is equal to 0.03. 0.003 266 51 by 419, 51 divided by 419, 12.17%, so 0.1217. Tax rate 1 minus 0.26, 0.74. This entire thing is the debt part, right? Plus for the equity part, 127889 divided by 127889 plus 419. This is equal to 0.996734. Multiplied by cost of equity. Cost of equity is coming to 11.76%. So 0.1176. Now we are in a position to find out the answer, friends. This is equal to, the value comes to be 11.751%. Right. So this is the cost of capital. This is the cost of capital. Now, friends, if you compare our cost of capital, which is 11.751%, with the return on equity, then you will find that we are on that side of the coin where the book value will be less than our projected intrinsic value per share, which we find out through residual income model. Now coming to the dividend discount model. So the condition for that is it has to have some dividends that is being paid, and we can see some consistency here: 17%, 21%, 22%, 20%, 16%. These are the payout ratios, right? And the payout ratios have increased. So we will use these trends to find out our numbers and do some valuation around it. So let's start with the valuation, friends. So friends, the first kind of valuation that we'll do is projecting the free cash flows to the firm for Eicher Motors into the future, and then discounting back to the present times and measuring the present intrinsic value, right? So for that, we will need to first find out the free cash flows to the firm for Eicher Motors, right? So the free cash flows to the firm are like this: 2173.75 crore, 888.34 crore, 1176.03 crore, 1149.65 crore, and 785.54 crore. So what we'll do here, friends, we will take a moving average because the numbers are a little volatile. We will try to take a moving average from 2016 till 2023. We'll take the numbers for each of the year's cash flows, and then we will create a 3-year moving average, right? How to do that? Let us witness it. So friends, here we have the free cash flow data for last 9 years for Eicher Motors, right? Now what we'll do is we'll create a moving average of 3 years at a time. So let's start with 2018. This is equal to sum of these 3 years divided by 3, 1283. Now we project it across the later years. Now this comes to be 1283.653 and increases up to 1990.363. Now why do we do it? We did it because we want to get a compounding rate or rate of growth for free cash flow in the short term, right? Short term growth rate, STGR or STG. So short term growth rate, STG, is equal to this 1990 divided by this to the power 1 by the time difference. The time difference is 1, 2, 3, 4, 5, 6. 1 by 6. This entire expression minus 1. The growth rate of free cash flow is 7.6%, let's say. short-term growth rate is 7.6%, right? What do we consider the long-term growth rate to be? Let us consider it to be the risk-free rate, or 0.0696. Okay. Cost of capital, K, we already have it. Let us check the number once again. It is 11.75%. So 0.11751, I think. Is it? Yeah, 751. So we have all these numbers, friends. Now what we need to do is we need to project. So we have a base year. Base year is 2024, right? So the free cash flow here is 2909 STG plus 1. This is equal to 1 plus STG. Now we'll be projecting these cash flows for the next 10 years. 1, 2, 10 years. And for the 11th year, we would find out the terminal value. This is the TV year, terminal value year, right? So, how do we do it? We multiply every year for the next 10 years the cash flow with the short-term growth rate. So, year 1 cash flow is equal to 2909 multiplied by short-term growth rate. Similarly, we do it for every year. And here are our numbers. And then for the 11th year, we calculate it by multiplying with 1 plus long-term growth rate. 6042.52 multiplied by 1 plus LTG. We have our number. Now this will be using later. Okay, the last 11th year cash flow will be using later to calculate the terminal value. For now, let us focus on the short terms, right? Now the cost of capital plus 1, this factor is equal to 1 plus the cost of capital. We also project this one also for the next 10 years because this will be required for our discounting of the cash flows to the present value, right? Now the present value of the short-term cash flows. This is equal to cash flow divided by discounted factor, that is the cost of capital, to the power the time period, right? This is the present value. Similarly, we do this for every year for the next 10 years. And we have the numbers. Now we'll calculate the terminal value. The terminal value comes to be the formula for this. Let us first understand the formula for this. The formula is 11th year free cash flow divided by cost of capital minus long-term growth rate. This is the formula, right? So we can calculate it here. This is equal to 11th year free cash flow divided by cost of capital minus long-term growth rate. So we have our terminal value also. Now we calculate our present value. How do I do that? Obviously, this is equal to terminal value discounted for 11 years with respect to the cost of capital divided by 1 plus cost of capital to the power 11. Now we have the present values for all the cash flows that we want to calculate. Now for finding the intrinsic value, all we need to do is sum them up. So intrinsic value, this is equal to sum of all these present value of cash flows. 63485. This is the intrinsic value. So per share intrinsic value comes to be intrinsic value divided by number of shares. How do we find the number of shares? Number of shares is basically market cap divided by price per stock. So we can easily find it. Number of shares. This is equal to 127889 divided by price per stock 4671. 4671. So 27.37936 crore shares. This is equal to intrinsic value divided by 27.37. So through 231875 Indian rupees per share. This is the intrinsic value as per the free cash flow method, right? So we have found our first valuation pricing. So we have found our first answer. Now we have two other methods left. One is residual income method and the other is dividend discount model. So first we'll do valuation through residual income method. Now friends, for the residual income method, what is the expression? This is equal to, the intrinsic value is calculated as current book value plus sum of the present values of all the residual incomes, right? This is how we measure it. Now the present value of all the future residual incomes up till perpetuity, this expression can be rewritten as B0 multiplied by return on equity minus cost of capital divided by cost of capital minus growth rate. Here B0 is the current book value, K is the cost of capital, return on equity is obviously the return on equity that we can get from the numbers. The G for perpetuity we will take as the risk-free rate. The risk-free rate that we took was something around 0.696 or 6.96%, right? The 10-year government bond rate. That is the number that we are going to use to calculate this intrinsic value, friends. So let's get on with the valuation in the Excel sheet. So friends, the sustainable growth rate we take as the risk-free rate only. This is equal to the 10-year government bond rate, which is 0.0696. Now the formula for residual income, we had already gone through it once. Again, I'll just put it down here. This is equal to B0, that is the current book value, plus B0 multiplied by the ratio of return on equity minus cost of capital divided by cost of capital minus growth rate. This entire expression. So this is the value that we want to measure, right? So I think we have the numbers for this, guys. B0 is 659. Return on equity is 0.242. Cost of capital is 0.11751, right? I think all these values are needed and we have all these values. So now we calculate the intrinsic value. This is equal to B0 plus B0 multiplied by return on equity minus cost of capital divided by cost of capital minus the sustainable or long-term growth rate. So this is coming to be 2371.355. So this is our second valuation number. This is the per share number directly only, right? This is per share number because the book value was per share. We did not take the entire book equity here. So this is the per share value. We have directly deduced it. Now the third and the last valuation that we need to do is the valuation of. So the last valuation model that we'll do is valuation through dividend discount model. So let's get on with it. So friends, for the dividend discount model, what we'll do? What we'll do is, for the next 10 years, we will calculate the net income, right? We'll project the net income. And we will also have a dividend payout ratio, right? A projected dividend payout ratio for the 10 years. This we will use to calculate the dividends for these 10 years, right? 1, 2, 3, 4, these 10 years, what is the dividend going to be that we are going to project with the help of this net income and the projected dividend payout ratio for the next 10 years. Then when we have D10, that is the dividend on year number 10, when we have this one, we will find out the 11th year dividend, with the help of the perpetual growth rate or the risk-free rate, right? This is 0.696, right? This one. And with the help of this, we will calculate a terminal value. Okay. We will calculate the present value from D1, D2, dot up till D10. We'll calculate the present value of all this and put the values here. And we'll also calculate the present value of the terminal value and we'll add all of them up. That's how we will calculate the valuation through dividend discount model. Now, let us find out how to calculate the 10-year growth rate with the help of net income projection. So friends, for the last 9 years, the net income for iShare has been these numbers: 1338, 1667, right up till 4001. These are values in crores, right? These are the net income values, historic net income values. Now from this, we are going to find out the STG, that is the short-term growth rate. That is the growth rate that we are going to take for the next 10 years, starting from the base year, which is year 2024. Okay. So how do we calculate that? Obviously, the short-term growth rate, we have to take the help of the compounding. So this is equal to 4001 divided by 1338 to the power 1 by the time period, which is 1 by 6. This whole expression minus 1 gives us a figure of 20.02%, right? Or 20.03% approximately. So let us use these values. Now let us do the projected mathematics. Net income base year is equal to 4001. Return on equity is 0.242, right? Now the short-term growth rate is 20.028, right? So we will use it to project the net income. 4001 multiplied by 1 plus the short-term growth rate. Now we will log this cell. Okay, we log this value. Now we'll project it for the next 10 years. And this is what we get, right? So we have the income numbers, net income numbers for the next 10 years. Now to find out the dividend payout, we have to ascertain a payout ratio, right? Now we saw that for the last 4 years, we have a payout ratio of 0.35. So we will use that. Let me cross check once again. So if you check the numbers here, you see in the last 12 years, the numbers initially were 17%, 20%, 21%, like that. But in the last 4 years, it is 34, 35, 34%, 34%, 35%. So I'll be conservative and taking this number only as the payout ratio for the next 10 years. Okay. So the payout ratio is 0.35. So the projected dividends, the projected dividends, this is equal to net income multiplied by the payout ratio. and we will lock this cell. So the dividends will be coming like this. These are the dividends. So the 10th year dividend is 8691 crores approximately. So the 11th year dividend will be this plus the perpetual rate. The perpetual rate we already have ascertained it, 1 plus 0.0696. So let us write it separately somewhere. LTG is equal to 0.0696. Right? We use it here. 8691.418 multiplied by 1 plus this long-term growth rate. This is our 11th year dividend. Now from this we'll be able to calculate the terminal value. The terminal value. This terminal value is given by D11 divided by cost of capital minus LTG. Okay. This is equal to D11 divided by cost of capital. We already have the number, and LTG also we have the number. So this is our terminal value. And these are our dividend values, right? Now we find the present values of all this. Present values of all dividends. This is equal to, if we write the cost of capital here, the present values can be calculated as the periodic dividend divided by 1 plus the cost of capital to the power the time. Right? So we will log the value of the cost of capital. We're just using another way of doing things. So this is how we get it. Now we have got all the 10 years. The 11th year also we will get. Only thing, we have to change one of the cells. Q43, we have to change it to Q44. So these are our present values, required present values. Now the intrinsic value can be calculated easily by summing them up. This is equal to sum of all these numbers. So it is coming to 78,348. And per share value, we have to divide by the number of shares for it. This is equal to this divided by number of shares. 2861. So this is our valuation with respect to the third valuation model, right? So 2861, 2318 through 2371. These are the values that are coming. So friends, this is how we do the valuation with respect to dividend discount model, residual income model, and free cash flow to the firm model. Here the lowest value has come from the free cash flow term and the highest has come from dividend discount model. So here the return on equity has not been required. We should delete it. It is not required. Now your work will be to do valuation for at least 3 stocks in the above ways, and we'll be reviewing it subsequently. So if you have any doubts, do let me know, and all the best. See you in the next assignment.
So, guys, try this assignment surely at home. If you come across doubts, share in the comments. I shall respond. For those who have enrolled to the internship, Share your assignments on the mail ID given to you. The enrollment link is given in the description. Hope you enjoyed this video. If this video added value to you, please like the video and subscribe to the channel. Share this with a friend who is interested in finance and investing. See you in the next assignment.